Are you often unsure about what makes an order block truly valid? Maybe you've picked one only to see price go off and reject a zone just above or below before going off and smashing your intended target. Well, in that case, you're not alone. The confusion normally comes from a misunderstanding of what constructs an actual order block. So in this video, I'm going to break down a simple 3-step method to find the right order block, reduce the number of fakeouts, and therefore the number of losses, and align yourself with the smart money. This isn't theory. This is just a repeatable system proven across thousands of live and backtested trades that helps you filter the good from the bad. Today, you will learn the formation characteristics that define a valid order block, how to confirm that the order block actually caused a structural shift and not just existed, and how to validate it through context and placement within the larger framework. This lesson is for intermediate traders who already understand structure and liquidity, but struggle to decide which order block is worth trading. By the end, you will know exactly which order block to trust and which to ignore. Right, just before we get stuck into the actual charts, I just want to go through the ideal example of what an order block would look like. So what you typically need to have is the start of an order block, which is going to be the pullback on a move. So move this aside for a second. If you think the way that the price moves in the market, you get an impulse up, a pullback, a break of the structure, a pullback, followed by another break of the structure. What we're looking for is we're looking for the move down, which looks as though price is sort of tempting people into the wrong direction. So this is where the trapped orders will be. So when you look at the chart and you find something like this, which we'll do in a second, we've got this impulse up. So, the impulse up, we've got the pullback, and then we've got the pull away again. So we've got the continuation. Now, with that in mind, the actual start of the order block is the peak of where price is starting to pull back from. Okay, so this is typically where your boss line is going to be. So for those of you who know market structure quite well, this is where boss is going to be. Then you've got the pullback phase, which happens, and you get the last candle. Okay, so this is an opposite candle. Then you've got a strong impulsive pull away. Okay, so this shows you the intention behind the market, that there's a load of orders which have been stacked in somewhere down here. Everyone was triggered going south. They were wrong. The market impulsively pulled away and then continues off on its journey in the correct direction. Alternatively, you can have a rejection candle, which is the same color as the prevailing trend, again, just showing you with the basis of the wick that people would try to get involved in the sell, but instead they were wrong and price pulled away. So what these guys are waiting for essentially is for price to sort of zigzag its way back down, showing lack of intensity. So on the way up, it showed a lot of intensity, a lot of momentum, but on the way back down, if we get a zigzag approach and it takes, say, twice as long to work its way down than it did going up, then we could quite firmly say that the order block is likely going to hold and we're going to shoot off in the intended direction. Now, if this imbalance disappears, or we have a very slow sort of like zigzag move away from here. So as an example, we've got the pullback and then we could get one impulsive move, but then if it starts slowly sort of zigzagging away, it's probably not got the momentum that we want it to have for when price comes back down to retest the area. It's probably going to be in an accelerated fashion. So the order block is very unlikely to hold. So we'll just have a quick look at the chart now and see if we can find a solid example. Okay, so here's a prime example of an order block which has worked out quite well in this situation. So we've got the opposite color candle, we have the impulse away, we've actually got a little bit of a gap as well, which is another good sort of confluence to add to your stack. And we have the start of the move working its way down here. So, and we've also got prevailing trend moving upwards. So if we think of how the market's moving, you could, be really precise with this. I wouldn't recommend counting every single pullback because you'll just drive yourself wild with getting stopped out if you're moving your stops too closely. But this is how the market is going effectively before it comes down, taps into the order block and goes. So what have we got? We've got the imbalance being formed here due to the impulsive move, and we've just had to wait for the market just to run out of steam. Yes, it came down quite aggressively before we tapped in, but there was so many confluences there to stack and say, well, actually, it's probably worth it. You can see just sort of past my head here that we've got consolidation period down here. Price has slowly pulled away. It started its little pullback. It didn't break below another previous structure, and then it pushed off quite aggressively. Then it started to stall. And quite often, if you think of this area here as another period of sort of consolidation, it's expanding outwards like this before it comes down, grabs whatever it needs to from around here, which is usually the liquidity from within the order block. Then off we go. So if you're drawing this on the chart, what you would look to do is you would mark out where the imbalance is between the last candle and the base of the wick of the connecting candle. So you'd go across there, pull across, and see that that is your imbalance. If price comes down and sort of mitigates the imbalance, and trust me when I say this, they very rarely create a break of structure or a change of character. Okay, so it's not the imbalance that we're trading from. The liquidity is within the order blocks. Because when you think about it like this is a lot of orders which are trying to push the market south. Then there are even more orders saying, no, you've got that wrong. We're going to shove the market up. And that is shown by the size of the candle, which is leaving behind the imbalance, which is showing a lack of liquidity in the area. And what does the market need to move? It needs liquidity. So what we're doing is we're not marking the imbalances because there are so many of them. It's the actual liquidity zones which we're marking out, which are the order blocks. So if you're looking to place trades off of the order blocks, all what you'd be doing is lining it up more or less on the zero. So basically at the start of the order block, put the stop loss just a tiny bit beyond to cover any spreads if price does come down to sort of retest the end. Just get that last little liquidity grab before shooting off. And I would recommend with this strategy that you be targeting no less than a 1-to-4 risk reward ratio. Now I'm just going to flip the chart upside down so we can see what it looks like around the other way. Okay, so again, in this example, we can see the prevailing trend is moving down, little lift up, aggressive move away. This is the opposite candle, which has formed an order block. Price has finally come back into the area and perfect. Price has pulled away. So that's how to identify the order block on the charts. That's really good and all, but now we need to look at the market structure and what are the key telltale signs that define a solid order block. And if this is useful to you so far, if you can just do me a quick favor and just hit the like button, that will tell YouTube that the video is pretty decent and it may be helpful to other traders out there. In order to help us identify elements of a market shift or the market structure, we're going to go back to our original example. I'd mentioned it briefly in the previous section, but we're going to cover it in a little bit more detail. An order block must create either a break of structure or a change of character. Now, what I mean by that is if we look at the highs of what have been created here, we've got a high here and then a high being recreated there. There's clearly a lift upwards in price. Then price pulls back, which means we're no longer creating new highs. That means that at this moment in time, this is our boss line, okay? It's what's going to be the break of structure should price continue. We do see that price does this and it prints a new high. Then a new high is printed, okay? So we're getting higher highs on a continual basis apart from this pullback section, which leads towards generating the order block. Now, if price was to pull back again and we print a lower high, and then we go off to break this section, this is where the break of structure is going to sit. So on my charts, you'll quite often see that I have some horizontal lines on there marking out where the break of structure is going to be. So I'll have on here, for example, a preset for the H4 break of structure, and I'll have an alert set by doing this, pressing create, that when price passes up through here, I will get a ping on my phone, on my watch, on the computer screen, which will say we've had a break of structure. I can then look for an order block because what we're looking for is the strength and momentum which follows the order block. In order for us to understand that properly, we then need to look at where CHOC is going to be based. Now, CHOC is just classed as change of character. All what that means is the market is currently pushing up in a momentum like that. We're looking at the low. We want to see a break of the low, preferably with a body break, which would confirm to us, especially if we then don't continue to break this high again and we continue down, that would confirm to us that we have had a change of character in the market. Now, the character in this instance, when you're talking about structure, is just direction. Character of an actual market can be classed as barcode action, it could be trending action, it could be just very choppy action that can be classed as character as well. But in terms of structure, a change of character is when you switch from creating higher highs and higher lows to lower lows and lower highs. So in our example, all what we're doing is we're looking at the lowest point between the previous boss and where boss has taken place, and we mark on there the low, which is going to be the change of character line. So should price break down below there, we've had a change of character, and then we look for an order block on the other side. But in this instance, what we're doing is we're going to the last candle, and we can see that there is also a huge imbalance. We've identified that as the pre-boss break as well. So another confluence to stack. But essentially, we have an extremely strong candle, which creates this imbalance, which indicates to us that there's a huge void of liquidity effectively here. The liquidity is now down here in the last candle. Just so happens to be as well that we have a long wick, which has rejected the low. And in this instance, what we have is a sweep of a low. The low does not necessarily have to be another structure which has been created over here. It can just be the low of the candle next to it. I don't particularly like it when we've got something like this, for example, when the order block which we're looking at is an inside bar. So it's actually inside of the previous candle. They're not particularly strong. But the ones which I do like tend to have swept the low of the previous candle or swept the high if you're looking at it from the other side. Alternatively, price could have mitigated with this order block a previous order block that if there's a huge imbalance leading after it, a little bit like this one. But in this case, what we've got is basically a mitigation of a busy area. I like to see order blocks of a very similar nature, essentially transferring the liquidity in the market. So if you've got one order block like this, and then price comes down, mitigates that, goes up again, but leaves another order block just like it, I see it as the orders from in here have been transferred into here, and then into the next one, and then into the next one. And you do see it happen on a fairly regular basis. And you can have a little bit of comfort knowing that there are huge amounts of orders which are going into these areas. And so let's have a look on the actual charts. Okay, so going through the structure and determining whether or not there's been a structural shift, we're just going to mark out on the charts where boss and chock would be. And again, just to reiterate, boss and chock is just to give us a bit of a directional bias, as we know that boss is likely to be hit 65% of the time, regardless of instrument that you're trading or time frame. Now, we do boss and chock slightly different from the rest of the SMC world over at FTR. And the reason for that is it tends to keep us in trades for longer. We can stay in trends for longer and we get faked out a lot less. So without going into a huge explanation, I will create another video to explain that in a little bit more detail. And if you want to skip the queue with that, feel free to apply to join us at FTR. It is application only. So people are invited on merit. They are not invited to just join willy-nilly. So you'll get a 3-day onboarding with me to accelerate your learning process and get you profitable probably for the end of the week. So we have the boss line being placed here and we get it broken with what looks like a red news event. Okay, so what I'm looking at is the imbalance which has been left behind right there. Okay, so if we draw that on the chart just to demonstrate where it was, and I'm also going to go into a bar replay mode just to make this a little bit cleaner. As it stands, we'll move into the next candle. Okay, so there is the imbalance. We're going to look at the structure of what had happened previously. So we'd had essentially the order block happen here. The order block would be identified here. It's the last candle up before the press down. Now, what did we do at the top of this order block? Okay, so in this instance, what we did was we'd mitigated a previous order block. And just to double check that, this was confirmed as an order block, even though it was only a wick break in this instance. we had a change of character, only briefly, but we'd continued in the journey down. We've got Chalk up here, we've got Boss down there, we've got the imbalance. The move had mitigated a previous order block, and this order block had basically just kind of swept the previous candles, maybe the last attempt to try to break up into this area. So if you're stacking the confluences, there's quite a few. You would essentially be looking at this and saying, this is a solid order block that I want to be getting involved with, especially if now price is going to essentially like zigzag its way up. So if it does something like this, it would be indicating to me, especially if the wicks are on the top, it would be indicating that momentum's still trying to push the market down. And that's what would give us probably the final confluence to say, this is good to go. And if I was trading this live, I would be setting my alert just below the area here and waiting for it to happen. As we can see, price was creating those wicks. We're having those structural shifts being confirmed. There was one here, sort of like a preliminary one. Then we had the major structural shift right there. And then we had the tap into the order block. So again, the way to enter, use the methodology that we teach and place your order and off you go. So to recap, we have now identified order blocks from formation characteristics. We've been able to confirm strong order blocks by using structural shifts and making sense from a structural perspective. But now we need to validate the order blocks using the larger framework. And now for the final part, validating the order blocks using the context of the wider timeframes. This is arguably the easiest part, but without it, you might as well just give up because this is the core differentiator between my strategy and the majority that you'll find out there. Because this is what will give you 10R, 15R, 20R per trade when you get it right. Even the strongest order blocks can fail if they're in the wrong place. And that's why we need to look at the wider framework as a priority. It's why in my trading group, we look at multiple time frame analysis. Think of it like this. We're going to assume in this example that the blue boxes are H4 order blocks or H4 points of interest, and the gray box is an M15. It is always safer to trade in the direction of a higher time frame and use that as your basis for boss. So if you're looking to target boss, you know that you've got about a 65% chance of reaching boss before you're going to chock, which is feedback in the other direction. You can have a super strong looking order block in the middle of one of these zones. So price would have taken off, pulled back on a retracement, which it has to do, and then feed its way into the next zone where you're expecting it to go. Now it's left behind a 15-minute order block in the middle of what I call no man's land or the range. So you're looking to trade in the range, not necessarily the best thing to do. The best thing that you can do is wait for one of these order blocks to form within one of these H4s. Okay, you'll be looking at entering on a lower time frame once you've reached your higher time frame target. And that is how we are going to be getting astronomical risk reward ratios compared to the majority of strategies out there. And it's pretty accurate. So adding context can help filter out a lot of the noise when you're looking at the charts, especially when trading order blocks. So I've gone back in time to August of this year, where in one of these days in particular, I got 45R using exactly the same principles as what I'm showing you in this video. And that video is coming up in the next couple of weeks. So if you haven't subscribed, do so now because you will want to see the exact trades that I took. And I am sharing and showing my broker statements to prove everything that I tell you. Now, looking at this chart, it looks a little bit messy, a little bit choppy. It is the 4-hour on the Euro USD. Now look at it with chart markups on. There we are. With a little bit more context, it starts to make a little bit more sense. So just to talk you through this, going based on the information that I've already shared in the first two parts, we've got the old chalk up here. So chalk was up here, and then price broke down. We got boss, then old chalk came there. We got boss again. So we chalked, boss moved to here, chalk remains actually all the way down there because the way that we do boss and chalk. So effectively, the market's going up. We're looking for buys in the market if we're looking to take entries off of the M15, which is our typical entry time frame for finding these order blocks. But we also need to consider the H4 order blocks, which is the higher time frame. So the higher time frame is represented by these blue boxes. Okay, these are the valid order blocks from what I can see. There's one here, there's one there, there's one there, and there's the target up there. We're not trying to target the old chalk line. We're not trying to target the highs. We're trying to target the liquidity, and the liquidity is at the end of the imbalance. Okay, so bear that in mind. Now, if we zoom in a little bit, you can see that I've drawn a load of gray boxes, which are essentially the valid M15s, which are there. Let me move this out of the way a little bit. That's to represent a typical trade using the H4, going from one H4 order block to the next H4 order block. And that's, we'll round it up and say that it's a 10R trade. So that's pretty decent from most standards, because we won't take any trades which are less than 1 to 4. On here, there's several trades which would have worked out fine on an intra-level basis, but there are also several trades that would have lost, because you're not looking at it from a higher time frame perspective and putting everything into order. So you've got the construct of the order block, which is the imbalance, a sweep of liquidity, or a mitigation. And then you've got the structural elements. It needs to have created boss, at least on its own time frame. It needs to lead to boss or chock on its own time frame. And you can filter out about half of these trades from losers into short-term winners. But the real winner here is the person who decides to drop down to the 15-minute within the H4s. So we're going to do that now. So on this lower one, we have a potential M15 here. It's an inside bar, but they do have less of an accuracy than the ones which are not. And then we have this one here where price is pressing down to create this. Well, it was actually a move up, but it's more or less at the halfway point of the H4. So that's already halved it. So within here, we've essentially been able to narrow down. And even though, yes, you'd be waiting several days for a trade if you trade only this way. And of course, there are ways to trade within the range, which you will find in several of my other videos that I do on a daily basis. And the guys in the group make our money on a daily basis. And don't forget, I'm showing you the M15 and the H4. Just think what you can do with the M15 as the H4 structure, like you're taking trades off of the M1. That's what I do. So looking at this, we're allowing the market to do what it wants to do. We know on the H4, which is the higher time frame, the wider context of the market, that we actually chocked all the way down here. We had a big news event to push the market up, and we're clearly going up towards this sort of choppy area up here. Yes, we get some sort of internal boss and chop, but the market chases liquidity of the order blocks. So bearing that in mind, yes, we get, boss here, therefore chop would move here, but quite often just below chock is going to be a liquidity pool in the form of an order block which wasn't hit. And we have that instance right here. While everybody else using, some sort of SMC strategy, which is too focused, I think, on structure, not enough people are looking at the actual order blocks, which is where obviously the big transactions are taking place, because it's what's being used to force the market in one direction to break the structure. So we've dropped down to an M15 on here. We've marked up our order block. If you'd have taken this trade right here on the H4, doing a swing trade, we've already calculated you'd make about 10R on your trading account, which is brilliant. Now, if we'd have taken the trade on the M15, this is what it would look like. We have more or less doubled, and we've increased it to 17R. Now, there's a possibility that we could have dropped down to a lower time frame, like the M1. So let's see if there's anything a little bit more precise for us to be able to get the entry from. Now, here we are with that M15 zoomed in, and there are a few order blocks which I would be marking out as potential entry zones. So we're just going to see if any of them would have worked if you'd have entered as a set and forget trade off of the M1. And if not, maybe you would just take a rejection trade. And talking of which, there is a link in the description below where you can apply to join me in my group, trade alongside me, be taught how to trade properly with me. And just as a thank you for filling it out, I actually give you this strategy that I'm going to show you in a second, potentially to get a reversal entry and make the most of the market's movements. So using the information that we've gone over before on the construct of the order block, the structure of the order block, and the higher time frame, we are obviously a time frame within a time frame within a time frame. Let's see what we can maximize this trade to. Here is a good order block. This had essentially break of structure, price never came back to it. We've got an imbalance. We had a press down to a mitigation right in the middle of another zone, which is another confluence which we use inside of FTR. We've got another one which had been mitigated, and then we have another one just here. It's almost touched this last one, but this would be classed as the extreme. So if we go all the way back, so let's see how it's reacted to the M1 order blocks that we placed. The price had come down and pressed through that first one. So if you used a set and forget on there, it would have failed. And it wouldn't have triggered the other two. Whereas if you were looking at the chart and setting your alerts where you're meant to be setting them, it means that you could have capitalized on how the price had worked down here with a little bit of surrounding knowledge on how candlesticks work. With our entry technique, which you can download, you would know that your entry would have been based off of this candle. So the entry would have been here, and your stop loss would have been either below this for a 2 pip stop, or to be very safe, you could run it to the end of the M15 and the H4 for a 5.5 pip stop. So let's just use that as the conservative figure. So here we go. If we zoom out and try and see this in comparison to the one next to it, that initial 10R became 17R, and now we're looking at, call it 30R. But if we manage to get the 2.1 pip stop, then this would increase even further to 82R, which again is an extreme example of what can happen if you're looking at the wider context of order blocks. And if you're choosing to trade the market correctly, you can cut out a lot of the noise by trading less. So to conclude this, if the order block has the correct candle structure, the correct market structure, and the correct context and placement, you can go ahead and place your trade. If it's missing any of those three things, skip it and move on, because the market doesn't reward chances, not in the long term. You have to be consistent with your trading, and our methodology is relatively simple. So if you want to get your best possible chance of trading this correctly, join me by following the link in the description. But if you feel like you need a little bit more knowledge on how this strategy can work on a moving chart, then watch this video where I show you how this exact strategy makes 272% in a single day.